Study Unit 11 is looking at property, plant and equipment. That's the focus, PPE. What is PPE?
Where do you see that?
It's a long-term asset, right? Okay, so we need some basics when looking at property, plant and equipment. 11. Okay, that's the focus. I'm just telling you what's in the actual notes. Okay, so to start off, we've looked at trading account now. Okay, we just covered it not too long ago. Trading account is what? Gross profits. Okay, because remember, businesses buy and sell goods. Do you agree? Profit and loss is what? Our net profit. Okay, it's what we're going to have at the end of our other expenses and other income. Okay, the net amount. Closing transfers is looking at closing off. Okay, so that would be what you did earlier, which is cost of sales, calculating it, closing off the account to get what you have at the end of the year. Right, always keep it simple, keep the elements in mind. We looked at this, I'm not going to look at that again. Just remember, PPE is different from inventory. Okay, remember, accounting is broken up into different sections, different areas. Okay, so if I have assets that I'm going to be selling, is that property, plant and equipment? No. If I have assets that I'm going to be selling, then that's inventory. That's study unit 10. Right, if I have assets that I'm going to be using, what is that? Property, plant and equipment. So do you see the difference between 10 and 11? 10 is something I buy to sell. Okay, so for example, the machinery that you guys buy to sell, that's inventory. Okay, the stuff that you're buying, like your laptop, your desk, your chairs, all of that, that's property, plant and equipment. Okay, so if I use something, it's PPE. If I sell something, it's inventory. Okay, make sure you have the difference between those two because it's a different section altogether. Okay, so what do companies need to operate? That's easy. We just spoke about it.
Property, plant and equipment.
Which is non-current assets. Okay, they need capacity to operate. Okay, so think about it. Would you be able to do your work if you didn't have a laptop?
No.
Would you be able to do your work if you didn't have a desk and chair?
No.
Would you be able to do your work if you didn't have a printer in the office? No. Okay, those items, furniture, laptop, printer, all assets. Okay, long-term assets. Assets that are used in terms of operations. Okay, so what am I going to be doing with those assets? Makes sense? Okay, so is the business going to record those in the books of the entity?
Yes.
Of course they will. Where are they going to show them?
Assets.
Yeah, where they're going to show the property, plant and equipment. That's what we're focusing on.
In property, plant and equipment.
Where?
Assets.
Where?
Debit side.
Where? Debit side of what?
Of assets.
Okay, but assets are disclosed where? In the statements. Which statements?
Statement of financial position.
Good. Okay. Disclosure is disclosure important? Very important. Why? The users want to know how much the business actually has. Okay, because if I know how much the business has, then that tells me about the business's ability to operate. Okay, where am I going to see the detail? I'm going to see the detail in the notes. Okay, financial statement notes. That's what I'm going to be looking at. Right, so detail will be in the financial statement notes. It's just something additional that we'll look at later on. Right, you'll talk about a property, plant and equipment notes. Okay, notes to the financial statements. Right, there's the description. Financial statements summarize the accounting information. Notes give the detail. Do I want detail with PPE? Yes, I do, because it's an important account. Right, here's some examples. Non-current assets are tangible, intangible, or financial, but they're all longer than 12 months. Okay? If they're tangible, there'll be things like buildings, machinery, vehicles, furniture, all things that you can see, you can feel, you can touch. Okay, those are tangible. Okay, they're assets that are physical assets. Property. If I'm going to be writing off their use over time, what do I call that? We looked at it when we did adjustments. What do we call the writing off of use of an asset? Waarde,
Waardevermindering.
which is
I can't remember the English.
depreciation.
Depreciation, okay.
Okay, right, so that's something that I need to account for. You know it from the adjustments. What type of account is it? Asset, liability, income, expense, capital drawings?
Expense.
It's an expense. Okay, so if it's an expense, what balance will it have?
A credit.
An expense.
Oh, it's a debit. Sorry, it's a debit.
Yes.
Sorry.
Okay, expenses have debit balances, so depreciation would have a debit. Right, we need to look at the cost. So with property, plant and equipment, the same thing applies. We just covered inventory. We spoke about historical costs. Can I change the cost?
No.
No. What I buy an asset for is what I buy the asset for. Right, so if I buy property, it's going to have a cost. If I buy equipment, it's going to have a cost.
Yeah.
Can I use a machine if it's not installed?
No.
No. So this is going to include any installation, setup, or any other costs. Okay, so if I buy a machine and it needs to be installed, I need to include that in the cost price of the asset. Right, how do we monitor and control the assets? We keep a register. Like you might even have one in your office. Hopefully. Do you?
What?
An asset register. Okay, you probably do, you're just not aware of it. Okay, because remember, obviously the owner of the business is going to want to know how many chairs and tables in the business, how many laptops in the business, how many vehicles in the business.
There are only 5 people, so it's so easy to count.
True, but you're going to want to know where all the equipment is. Okay, even though it's a small business, it still needs to be something that you need to consider. Okay, and that's what we're going to be looking at here in terms of monitoring and controlling the assets. Right, this you've seen before. You know how to account for depreciation. Tell me the why for the first two. Okay, so I've got debit, property, plant, equipment, credit, bank, or creditors. Why do I do that? What's the transaction? Buying or selling?
Assets.
Buying or selling?
Oh, buying.
Good. How am I buying those assets? Cash or?
Money. Cash.
Or credit. Okay, so bank, if it's cash, liability if it's credit. Okay, so asset increase, asset decrease, or liability increase. Okay, depending on what you're doing. Am I using cash to buy or am I using a liability to buy? Right, it's important to understand what the transaction is in terms of its elements. Okay, always bring it back to its basics. Is that right? Okay, this we've looked at in the adjustment chapter. We spoke about depreciation being expense. You mentioned depreciation will have a debit. What is accumulated depreciation? Do you remember?
It's depreciation over a certain period of time.
Good. What type of account is it?
It's an expense.
It isn't. The depreciation is the expense. The accumulated depreciation is what?
Liability.
Almost. It's similar to liability. It's a negative asset. Okay, the reason why it's a negative asset because it reduces the balance of the asset because I want to know what the carrying value is. Okay, right. So we've spoken about carrying value in FAC 1501. Okay, we spoke about cost minus accumulated depreciation. If I take cost minus accumulated, I get the carrying value. Right, that's what I'm looking at. Is the carrying value. Carrying value is how much the assets are worth today.
Okay.
That's what you're looking at.
Wait.
Okay, still need it. Okay, so that's carrying value. Carrying value, book value, it's the same thing. They just talk about it in different ways. Okay. Right, am I going to have to draw a timeline? Yes, especially for these exercises. Okay, so the ones that you did in 1501 were basic. Were simple. Right, in 1502, the same theory applies, but it's a bit more tricky because they give you more assets. Right, so the best way of getting around it is to draw a Timeline. If you've got a timeline, you can see everything. Okay, that's the approach I'm going to take when I show you how to do the past papers. Okay. When using a table, it does help. We're going to look at cost, depreciation, accumulated carrying value for different assets using different methods. So what methods do we have? We've got two. This you probably recognize, right? Straight line, diminishing balance.
I remember it.
See, good. Okay, so we're going to revise it. Okay, straight line, what do I use as the base of the calculation? I use the cost price. Right, cost price is the historical cost. We spoke about that earlier.
Yes.
That doesn't change, right? So is the depreciation going to change? No, the depreciation is going to be constant. It's going to be an amount that's going to be written off the asset's useful life.
Yes.
Diminishing balance, is that going to change? Yes, because it gets calculated on carrying value. We just spoke about carrying value. Carrying value is?
It's used as the basis of the...
No, carrying value is what? How do I calculate it? Cost minus accumulated depreciation. Is that okay? Right, so cost minus accumulated depreciation gives you carrying value. Right, carrying value, will that change over the asset's useful life?
Yes.
Will it get bigger or smaller?
Smaller.
Good. Okay, so the depreciation is going to diminish. And that's why you've got diminishing balance. Makes sense?
Okay. Yes.
Okay. Next bit. We've got an example here. I want you to calculate the depreciation for this asset. It's straight line, so is the depreciation going to change?
No.
No. Okay, I want you to use these columns. Okay, so just draw up those columns. Cost price, depreciation.
Can I use these columns?
No, you can't use those because there's other examples. Okay, so just draw a little, small little, like this one, eh?
Yeah.
Yeah.
Thank you.
Okay. Alright, so let's have a look at it. Okay, so you've got all those columns, right? Okay, so I know the asset is worth how much?
500,000.
500,000. What is that representing?
The cost.
The cost. Is that going to change?
No.
No, it's not. What is the depreciation? Well, 5 years. 5 years is the same as 20% per annum.
How do you get that?
Because 5 times 20 is 100%. Okay, so I'm looking at the useful life of the assets. Okay, so if I have an asset that is depreciated over 5 years, I'm depreciating 20% every year.
Okay.
Okay, so now I'm going to record that. What is the cost of the assets?
500,000.
500,000. So 500 is going to go there. Will that change?
No.
No. How many years? 5 years. Okay, so I'm going to write down 500,000 for 5 years.
Okay, so okay, I need some time. Oh, I don't have so much space.
Yeah, try squeeze it in if you can. Okay.
Okay.
Got that?
Yes.
Okay, what's the depreciation rate?
20%.
20%. This is straight line, right?
Yeah.
So straight line is going to be calculated on cost. So I'm going to take this and I'm going to times it by 20%, 20 over 100. Okay, it gives me 100. Is the depreciation going to change? No, it won't. Okay, so accumulated is how much depreciation you have every year. So in the first year, I'm not going to have any depreciation to start with, but I've got 100,000 to end the year with. So what is the carrying value at the end of year 1? 500 minus 100, which is 400,000. Okay. Right, we just spoke about straight line using what? Cost. Is that going to change? No. So I can literally write the same thing 5 times. Does that make sense? Okay, cost price. Straight line. Straight line method uses cost as your base. Depreciation for straight line will always be the same. What would your accumulates be for the second year?
205.
Yes, so I had 100 to start with last year, plus 100 this year. So my carrying value is now what?
300.
Correct.
Okay, this is easy.
How much do I have accumulated for next year, third year?
300.
300.
So carrying value is 200,000.
Okay. Then 400,
And 100.
and then 500. Make sense?
Yes.
Great. Okay, so that's the one method. Here's an example for you to try. B, asset bought for 960,000, calculate the yearly depreciation. Okay, so exactly the same thing, but it's 25% per annum. So how many years?
1.
25%. 4
So-
years.
Okay.
4 times 25 gives you 100.
Yes, it's 4.
Okay, 4 years. Right, will the cost change? No, it won't. The cost was given in the question as 960. Okay. Let's see if you can complete the table. Try work that out, and then we'll check it.
I could have checked there.
Okay, yeah, so this is the answer. You obviously have 240,000 every single year. That doesn't change because it's straight line. And then you'll have accumulated depreciation, which accumulates, meaning they're added to the balance. Last year plus this year gives you that. Last year plus this year gives you that. Last year plus this year gives you that. Okay, good. Alright, let's continue. Next bit. Diminishing balance. Okay. Diminishing balance is going to need the same tables. Okay. One, 2, 3, 4, 5 years. Diminishing balance. Okay, so diminishing balance is going to be calculated on what? The carrying value. Do you agree?
Yes.
Okay, so am I going to use the 500?
Yes.
Only for the first year.
No.
I'm not going to use the 500 for all the other years in terms of calculating the depreciation.
I'm not with you anymore.
Okay. No, that was right. The cost doesn't change. The cost doesn't change. You had it right.
The cost needs to stay the same. Okay.
Yes, that's right. The cost will never change, right?
No.
Okay. The depreciation will change. This is over 5 years. Okay, so 5 years is the same as 20%. Okay, so depreciation for the first year is going to be 100,000. So that means the accumulated is 100,000. Carrying value is now 400,000. Do you agree?
No, I'm not with you. I'm just writing.
Okay, what is the depreciation?
It's 100,000. But how do you get that 100,000?
20%, 5 years.
Oh, okay. Okay, cool. I'm with you.
Okay. Right, now how do I get depreciation here? Depreciation here is calculated on what?
On 400,000.
Yes, on the carrying value, exactly. Okay, so this times 20%, or divide by 5. Accumulated 180. Carrying value 500 minus 180. Is that alright?
Yes.
Okay, next. What is this depreciation calculated on?
32.
Correct. Times 20%. Okay, gives me depreciation gives me that answer. And then you're going to do the rest. This gets calculated on that, and this gets calculated on that. And that's how you do diminishing balance.
Isn't there a way that you can work it out on your calculator?
No, you've got to do it manually in case, yeah.
Okay.
Okay,
Interesting.
is that right?
Yeah.
You sure?
Yes.
Okay, so this one I want you to do, there's the depreciation, same as what we got. Okay, this one I want you to do as practice. I'm going to put up the answer here on the video just so we've got it, but I want you to try do it yourself ahead of time, and then we can always check it later. Okay, so I'm just going to copy that because that's what I'm going to be using. It's the same cost. Okay, and then I just need to fix the. Okay, so depreciation is fine there, the first bit is fine. So this will be times 25%. Okay. Okay, so that's basically what I'm going to be getting. Right, so that's what you would get for this question, diminishing balance. Right, the last bit is just a note. This is just something additional that the study guide gives you. It's not in the textbook, but the UNISA study guide gives a note here about units of production. Okay, I've never seen them test this because it's literally one example in your study guide. Okay, it's just looking at number of units. So this means the machine is going to manufacture 5,000 units. So in year one, if I manufacture 500 units, I'm going to divide 500 by 5,000 and times it by the cost. Okay, next year I manufacture 1,000 units. Then it's going to be 1,000 over 5,000. Yeah, so you can look at the example. It's very basic, it's very simple, but it's just something additional just in case. Okay, but like as I said, I've never seen it get tested. Okay, it's just something additional that the study guide provides you with, but the textbook doesn't have it at all. Okay. Right, this is important because this is the notes. Okay, so earlier we spoke about the notes to the financial statements. What does a note do? It shows us detail. Okay, what am I going to have at the beginning? I'm going to have the opening balances. What am I going to have at the end? I'm going to have the closing balances. Right, so when looking at depreciation, I know that property, plant, and equipment is going to have what?
An opening balance.
Movements during the year. So I'm either going to buy more, I'm going to sell some of it, or I'm going to depreciate it. Okay, so here I've given obviously no disposals, I've given additions, and I've given depreciation. And then I've got some missing figures to find out. Okay, so this business has 128,000 starting, which is made up of cost price of 160 and accumulated of 32. Did I buy more equipment or machinery or plant during the year? Yes. So that gave me 150. So 150 plus 160 is how much? 310. See, there's the costs.
Oh, yes.
Alright, so that's what I've bought. Then I've got depreciation. How much depreciation did I start the year with? 32. How much depreciation do I have during the year? 47. So what's 32 plus 47?
79000.
Correct. Okay, so what is the carrying value at the end of the year? 310 minus 79. Quickly work that on the calculator. 231. Okay. Right, 231 will be the carrying value. Right, so it's just format. It's showing you the opening, the movements, and the closing. That's what the note does. The note gives more detail. Right. What happens if depreciation, or let me say this, what happens if I don't have a full year? Can I still depreciate the asset for a full year? No, I can't.
You need to work out the depreciation for that.
Exactly, yeah. So that comes from your previous, also 1501, we did the same thing, right?
Yes.
Okay, we're going to do the same thing here. Pro rata depreciation. Okay, so if a new asset is worth 800,000 and it's purchased 4 months before the end of the financial year, how much depreciation are we going to have for the year?
Excuse me?
How much depreciation will I have for the year if I've used the asset for 4 months?
4 months depreciation, so it's
800,000 times 20%, 25% times 4 months. 4 months is 4 over 12. Okay, have I used the full year? No, I haven't. Okay, what method am I using here? Straight line. So what do I calculate depreciation on? The cost. Is the cost 800? Yes. Am I going to change the cost?
you
No.
can change the price.
Can't change the cost. So 800,000 times 25 gives me 200,000. Have I used the asset for the full year? No. So can I show depreciation for the full year? No, I can't. Okay, that's why I prorata it. Okay, you can do that in one step if you want to. 800 times 25% times 4 over 12 will give you 66,66666 recurring. Okay, but I'm just going to show it separately. It doesn't matter how you do it as long as you get the right answer. Okay, so what's the carrying value at the end of year 1?
200,000.
End of year 1. Carrying value. How do I work out carrying value?
600,000.
No, it isn't. How much depreciation did you have for year 1?
Oh, only 4 months.
Yes.
So it's 800,000 minus 667.
There we go. There we go. Okay, you can't write off more depreciation if you haven't used the asset for the full year. Does that make sense?
Yes.
Okay, good. Right, next page. Bit of notes about disposals. Right, so what is an asset disposal? It's just a way to write off an asset. Okay, so when looking at an asset disposal, what am I doing to my asset? I'm removing it. Okay, asset disposal means get rid of your asset, sell your asset. Okay, so with an asset disposal, I can either sell the asset, I can write off the asset, or I can trade it in. It depends. Okay, these are the steps that we're going to follow. Okay, we'll use examples next week from the book. I'll show you how to do it. But this is the process. So process the depreciation. Why? I need to know what the asset is worth today. Right, when I actually sell the asset. Right, so if I've used the desk up until the end of the month, I need to depreciate the desk up until the end of the month. And then I'm going to remove it. Okay, dispose of the assets. Right, and they call that an asset realization account. Okay, we're going to transfer accumulated depreciation because that's what the asset is worth. Okay, in terms of its carrying value. So we're going to take out the accumulated depreciation and we're going to write off the cost. Okay, the cost is going to go through to the realization account. Then we're going to record any amount received, so proceeds from the transaction, and then we're going to have a profit or loss on disposal, depending on what we've got. Okay, so let me show you how we would do that here, and then we'll do examples next week. When focusing on the asset realization account, it's a T account. That's what the T account looks like. Okay, T account, debit side, credit side. Okay, if I'm writing off the value of an asset's cost price will go on which side, debit or credit? Well, let's think about it. An asset has a balance on which side?
Debit.
Good. Okay, so the debit is going to go on this side, and this will be the cost price of the asset. Let's just say it's vehicles. I'm selling a vehicle. Okay, so if I'm selling a vehicle, on this side of the account, you're going to have the cost, whatever the cost is. Okay, if I'm selling the vehicle, will the vehicle have accumulated depreciation? Yes. What balance does accumulated depreciation have?
Negative.
A negative balance, which is on which side? Credit side, exactly. So then I'm going to have accumulated depreciation here. And this will be for the year. Okay, the asset that I'm going to be selling. Right. Proceeds. If I'm selling the asset, will I be getting cash? Yes. What is cash going to do to my bank?
Increase.
Alright, where does bank increase?
Debit.
Debit side. So you'll debit the bank and you'll credit the disposal. So the bank will be referenced here. Okay, that'll be CRJ. Okay, why CRJ? Debit the bank, credit the disposal.
Yes.
Okay, and then there'll be a profit or loss. I've put it over here. Right, so if I sell a vehicle, let's say I sell the vehicle at more than its carrying value, will I make a profit or a loss?
Profit.
Exactly. If I sell the vehicle at less than its carrying value, I'm going to make a loss. Right, so that's what you're going to have there. What balance will a profit have?
Positive.
Which side?
Debit.
Profit. Profit is income.
Okay, so it will have credit balance.
Credit balance. So you'll credit the profit on sale and you'll debit the realization. So that's what you'll have here. So I'm just going to put that in green. If there's a profit on sale, the profit on sale will go here. Okay. If I have a loss on sale, where do you think it'll go?
On the credit side.
Yes. Okay. So loss on sale is going to go here. Why? Because the debit will go against the loss. Debit the loss, credit the disposal. Right, and that's what the disposal account will look like. And then right at the end, you'll just balance it off. Both sides of the account must equal. Okay, so you won't have a balance brought down, balance carried down. It closes off completely. Okay. Right, so just note the account closes off, no opening or closing balance. Why? Do I still have the asset after I've sold it?
No.
No. So will I still have this account after I've processed it? No, you won't. Okay, and then basic rules still apply. Apply to the working account. That's why I said vehicles is an asset, it has a debit balance. Accumulated depreciation is a negative asset, has a credit balance. Bank and loss and sell and profit, those are contra accounts. Okay, so if bank goes up, then your disposal will come down. Alright, so it's only those first two that you can use the rules. Right, and then obviously the last bit is just, I should have just revealed it instead. Okay, there's it there. Cost won't change, it's on that side, profit on this side. Accumulates on that side, bank proceeds, loss and sale, which is what we just spoke about.
Yes.
Okay. Right, then don't forget the rules. Profit relates to income, loss relates to the expense. When looking at assets, you've got two things. You've got the cost, which is the debit. Three things. You've got the accumulated depreciation, which is the negative asset. Okay. The third thing would have been, what did I miss? Bank. Well, bank would have been proceeds, would have been an asset. Okay, if you're receiving cash. Right, and then that covers some more theory. Right, so we'll leave the workings for next time. Okay, I'll take you through the examples in the study guide. We'll do the asset realization depreciation calculations there. Okay, happy?